Good morning. Thank you for joining our third quarter 2025 Venturi Private Wealth webinar. So I'm George Clark. I'm a member of the investment team, and I'm looking forward to this chat with both you and my investment team colleagues. So each possess some specific remarks on both the markets and economic trends. I'm joined by our senior investment team member, Weston McIntyre, our CIO, Ashi Parikh, and George Newman, portfolio manager. As a reminder, please share your questions and comments via the button on the bottom right-hand portion of your screen. We'll field them after the initial commentary. So let's dive in. I'll turn it over to our CIO for market commentary, Ashi.
Thank you, George. First of all, thank everybody here. First, thank George Clark and Russ Norwood, our co-founders. Next month, we embark on our 10-year anniversary at Venturi. A couple of milestones, not just the 10-year, but also crossing $3 billion in assets under management and on 40 employees now, 40 teammates. So a great tribute there. And obviously, without your faith and confidence in us, we all wouldn't be here. So thank you very much. We're going to talk a little about the macro economy, the returns we've had. We'll dive into the consumer. We're going to talk about tariffs, which have been out there, and then go forward future outlook. So you can see on this chart, draw your attention to the S&P 500, 7.8% return. This is through July 18th, last Friday. The international, what a great return we've had after a dormant international and emerging last few years. And you can look at the returns on down to the right, even the Bloomberg Ag and our 60-40 balanced at 8.3%. So smooth sailing and asset allocation worked and everything was fine, as we well know. But for those of us that follow the market a little bit closer, we obviously know that there was nothing but huge volatility. So for all investors alike, we're all reminded once again to stick with the asset allocation that we have. If not, we revisit that with our advisor from time to time. But if you look at the S&P 500 return from February at the peak, the short-term peak was about 6,100. From that time on, in the next 50 days, we went down 17% on the S&P. We had the macro risks. We had the downgrade of the U.S. Sovereign debt. Our credit rating went down. We had the big, beautiful bill that was underway and fears of greater inflation and deficits. And so a problem with the dollar and our fiscal responsibility. We clearly front and center was the tariff situation, which is still ongoing. And the fear there is, again, trade wars and potential fears of inflation and taxes going up, and therefore earnings would go down. We had all those fears, not to mention the geopolitical fears that have been in the news. So all of this being thrown at the market. But from the time that was announced in April, we then rebounded 26% on the S&P 500. So we went down 17%, which was $9 trillion of value. We gained 26%, which was $13 trillion of value. So the U.S. Equities is about $52 trillion. We had a $23 trillion swing in just that 5-month period. So extreme volatility, which again, as I said, reminds us of, that old adage that time, not timing, creates long-term wealth creation in the markets. In addition, this was another point in which if you had over the last 20 years invested $100,000, it would be $350,000 approximately. But if you missed the 10 best days in the market, those returns would be cut in half. So 100,000 would only be 175,000. So this past 5 and 6 months was a perfect reminder for all of us to stay with our long-term asset allocation plan and not worry so much about the underlying volatility, which comes from time to time. In terms of the returns that we had by sector, take a look here. You can see the industrials led the way, 15.7%, followed by the utilities, which is many people may not have thought about that. But if you think the industrials had a very solid year last year also and continued this year, Ever since COVID is gone, the supply chains have rebuilt. We've had policy backdrop where there's more onshoring. And so this notion of American exceptionalism carries through to our industrial companies, our backbones, General Electric and United Technologies and Raytheon, Union Pacific, Deere, Cat, Boeing. So some of the things that have carried the country have done well. In addition, utilities, as we have, two wins at the back there. Number one, the electric grid needs to be upgraded, and that's going to just nothing but increase demand that's out there for electricity. Then obviously the second piece of that has been quite a bit in the news is the data center build out. And so that's going to increase the demand for electricity. So companies like Constellation Energy, Duke, Dominion, here in Texas, Sempra, which owns Encore, all have done extremely, extremely well. And you go down the list of some of the basics, you even see materials in there with a broad return: cement, copper, building materials, paint. So Vulcan and Martin Marietta and those kinds of names, Dow Chemical, DuPont. So a very broad-based, healthy underlying economy. The underperformers were consumer discretionary, fears of inflation, and the consumer purchasing power continue to remain out there despite some of the data that we're seeing. Those sectors haven't done well. And then healthcare, which has been in the news front and center, number one with the assault now on drug pricing, and also with some of the shenanigans that have gone on with the underlying HMO companies that have been in some trouble. So overall, a pretty solid first half of the year. In terms of this chart, just look at the far right, the equal weighted S&P 500. So despite the run we've had, the past 6 years, the equal weighted S&P's averaged 16.3 times. We're at 16.9. So again, nothing here in terms of valuation is excessive in the broader markets. This is a chart that we like to look at from time to time. It's kind of an inverse chart. It gives you the institutional managers, the so-called professionals, and what their sentiment is. So anything above the line is the fear that there will be a recession. So if you look at the red circles, March of 2009, you can see during the financial crisis, or April of 20 during COVID, you had a reading of 80%. Usually anything above 20 or 25% is more than one standard deviation. So if you look at April of 25, we're over 40%. And the underlying sentiment was that because of what was going on, we were going to go into a recession. The media, the politicians in Washington, and then clearly the sentiment and the noise that was out there, not to say it wasn't real, but it was more of sentiment. Whereas if you look on the next chart, now this is a very busy chart, but just look at the color coordination. Green is good. So this is the real underlying factors. These are about 30 variables that we slice and dice and look at the economy in different ways, from manufacturing to what's the trade balance, what's the inflation, what's the producer price index, what are existing home sales, on and on and on. And 90% of those variables, even in April, the underlying economy was green. So despite what the macro kind of the sentiment was out there, and despite what was out there in the news and all the geopolitical, the underlying economy has still been performing at a very solid pace. We look at the labor market, another indicator that we look at very strongly. The top chart shows that labor continues. Anything above the positive bars are new jobs created. Non-farm payrolls continue to go up and continue to be fairly consistent. And you can see on the bottom chart, the unemployment rate, even though it's ticked up from a year ago, it might have been a bit low. We're still pretty steady at 4.2%. So the jobs are looking good so far still, and the unemployment rate is hanging in there. So we've heard a lot about the consumer. And so with that, the backdrop has been pretty positive as we've gone through just about 7 months of 2025. But to drill down a little bit more on the consumer, I'm going to turn it over to Weston.
Thank you, Ashi. So as Ashi mentioned, the labor market, it's remained rather resilient. Payroll growth is shifted down a little bit, but it remains positive, and that's really why the U.S. consumer is still acting as the economy's shock absorber. So in dollar terms, households in the U.S., they spend almost a little bit over actually $20 trillion a year. And that's nearly 70% of the entire US GDP. And of that spending, only 30% is spent on goods. The other 70% of that 20 trillion is spent on services, which are inherently less prone to tariff price increases. This dynamic is pretty unique to the US. When you compare it to the EU and China, consumer spending only represents about 40% of their GDP. So what this means is that the US economy, it's generally more resilient in downturns or downward swings in exports or slowdowns in foreign direct investment or government spending cuts. The US is very much a consumer-driven economy, and that consumer spending engine is largely concentrated in the top income earners. This chart, it puts that into perspective. It shows how the top two income quintiles, or the top 40% of income earners, account for about 70% of total consumer spending. So if tariffs potentially raise the price of imported goods, it is a consumption tax, which isn't great. But given how much consumption spend is among the upper income cohorts with the biggest budgets and room to absorb these price increases, we think the economy likely has room to absorb a tariff-induced price hike rather than resulting in a sudden growth shock or an immediate outright cut to consumer spending. The point here shows up again when you look at deposits. This chart shows FDIC data, and it indicates that the highest earning 20% of households in the country, they hold more cash in deposits than the entire 80%, the bottom 80% combined. And additionally, the top 20% of households, they own about 90% of equities that are owned by individuals in this country. And so thanks to the past dozen years or so, we've had 190% rise in the S&P 500, and there's been about a 60% appreciation in the median home prices over the past 12 years. So affluent households have amassed pretty sizable gains in both their portfolios and real estate wealth. This wealth effect, if you call it that, should give top income consumers enough cushion to keep spending even if tariffs push goods prices marginally higher. So we monitor this by observing and paying attention to the total inflation adjusted consumer outlays, or sort of the overall spending rate that consumers spend. And overall spending rates are still 2.4% higher than last year's level. Now that's off a little bit. It came down from 2.8% a year ago, but it's still solid. It's still a solid pace compared to the last decade, and really nowhere near a contraction level. So drilling a little bit more into consumer spending and this wealth effect that I talked about, it explains why these early tariff rounds to us look like more of a consumption tax than resulting in an outright growth shock. This chart shows June retail sales month over month, and headline retail sales rebounded 0.6%, highlighted here in red. The gains were pretty broad-based across every major category of spending, except for, as you can see down the bottom, gas stations, a pullback in electronic and appliance stores, and a pullback in furniture stores. These categories are, especially the last two, no surprise, they're most exposed to tariff price increases. But what this chart doesn't show is that the June data, it broke a 2-month losing streak, which was likely negatively impacted by an anxious consumer that was worried about tariff headlines and their potential impact on the economy. But year over year, retail spending, it's still growing at a very healthy rate. It's up about 4%. Another relevant data point here is e-commerce spending. It continues to set new record highs. Households spent an annualized $11,000 per household online using the May data. That's a new high. The strength continues to also line up with the growing income data that we see. When you look at real disposable income growth, it's growing about 2% year over year. Now that's down again from 2.7 the year prior, but still very clearly positive. So put simply, the consumer, they appear to be bending a little bit, but not breaking in light of tariffs. And so as long as the job growth holds up and the wealth cushion remains intact, tariffs should largely, we believe, stay as sort of a one-time nick to purchasing power rather than a knockout punch here. In terms of another encouraging sign that we've seen is inflation expectations. It showed up on the chart Ashi showed earlier. For a few months, it was red there. But inflation expectations, they've retreated from their spring spike. The three lines on this chart, it shows 1 year inflation expectations as surveyed from everyday Americans. The survey results from the Conference Board, the University of Michigan, and the New York Fed. They all show and tell the same story. In January, average Americans surveyed by this expected prices to rise a little over 3% over the next 12 months. But by March and April, the view had surged to nearly 6% as tariff headlines and the inflation worries dominated the news. But since then, they've come down. Expectations have eased back to roughly kind of the 4% range. 4% inflation rate, that's still double the rate that the market has priced in. The market's priced in around 2% when you look at inflation-linked bonds, but really the direction of travel lower matters here most. A consumer that's less worried about future inflation, they're less likely to pull back on discretionary spending, and that helps continue the strong gains and the strength that we've seen in retail sales and thus, the earnings picture. So in terms of turning to inflation, the headline CPI, it printed 2.7% year over year in June. And that was a tick higher than the inflation rate that we had come out in May. But the point here, I would say, is compared to where inflation has come in versus expectations, it's been below consensus for 5 straight months. So the good news is that sticky inflation, shelter inflation here highlighted kind of the right-hand side, as well as services inflation, those have all cooled. Shelter inflation has cooled for 3 consecutive months, and core services, excluding energy, is now 3% year over year, which is down nearly a full point from where it was in 2024. These two categories, they were the post-COVID holdouts that remain sticky, where the Fed has been laser focused on bringing down. So progress on bringing shelter and services inflation really matters in terms of the rate cut debate that's ongoing with the Fed. The catch is that goods inflation, where tariffs are likely to bite first, it just flipped from mild deflation in May to up 0.7% year over year in June. And this jump, it's really concentrated in the tariff sensitive areas: appliances, household furnishings, technology, electronics, and even toys. And it's not by coincidence that, these are also those retail categories where we saw sales decline in June. So as of now, it looks like that companies are appearing to eat part of the extra cost that we're starting to see show up in goods inflation. You can observe that by looking at wholesale and retail margins. Margins have slowed a little bit to 2.9% year over year, which is the lowest margin rate in the past 7 months. But with companies absorbing some of the price increases, then that's a good thing in terms of overall inflation rate. It's probably one of the reasons that we haven't seen inflation go above 3%, at least not yet. Moving on to tariffs, this is really kind of say the main source of today's uncertainty. So August 1st is obviously, I'm sure everybody on the webcast has been following the news, is a big day. It's being dubbed Liberation Day 2.0. And unless last minute reprieve or unless there's a push out, a reprieve of the deadline or trade deals are struck, really the blanket duty on most imports is set to climb from 10% to 15%. But in the last 2 days, we've seen some announcements come out. Overnight, we saw an announcement on a trade deal with Japan. We saw a preliminary deal come out with Indonesia and the Philippines 2 days ago or yesterday. And we expect that there is something that could likely materialize with the EU. There's a lot of talk about an EU trade deal potentially getting done before the August 1st deadline. But layered on top of the baseline increase are country surcharges. The country surcharges are largely mirror the April proposal that came out on the original Liberation Day 1.0. There are some notable increases. Brazil rises to 50% and EU rises to 30%, hence kind of the urgency to get a deal done with the EU. Canada and Mexico, they face a 35% and 30% surcharge respectively, but the effective hit with Canada and Mexico is actually rather small. About 90% of Mexico and Canada's imports into the US fall within the US-Mexico-Canada agreement, which has tariff exemptions. So only about 5 to 10% of the tariffs would be at that higher rate. There's also sector carve-outs here. Those are important too. Tariff exclusions on semiconductors and pharma are likely to be delayed and pushed out for up to 18 months, which puts them past the midterm elections, which could be sort of a negotiating or a sticky point in terms of politics. But when you stack everything together, the effective rate, which is the average duty actually paid, it moves from the start of the year, which was around 2% to 13% today. And most estimates put it increasing around 4% to 17% effective tariff rate if everything that is slated to occur on August 1st goes into effect. That would put the effective tariff rate at the highest it's been since the 1930s. This is just really more detail on what I outlined on the last slide, but I think it's helpful because obviously the trade negotiation process has been public and very messy, and it's really difficult to keep it all straight. There's been a lot of announcements, but what it shows is that the effective tariff rate, which is highlighted here in red, it peaked at 26% in early April. And that was during the tit-for-tat spike when China's tariff rate briefly surged to 125%. There were subsequent exclusions for electronics, auto parts, and China tariff rate was rolled back to a 10% baseline, which pulled the effective rate to about 13%, highlighted in green where we are today. So looking forward, the orange or the yellow highlight here shows that projected rate of 17% once the August 1st surcharges and the step up from 10% tariff rate to a baseline 15% tariff rate kick in. This figure, obviously can shift. We've seen deals come out the last 2 days, last minute deals and further carve outs are definitely possible, but the broad range is pretty clear. We started the year at 2%. We're around 13% effective tariff rate today, and it could be nearly 17% in 2 weeks. So finally, what does this all mean and how does it translate into the Treasury? So over the last 3 months through June, custom duty receipts received by the U.S. Treasury have hit in the past 3 months $88 billion. And that's an annualized rate of roughly $360 billion. And that's under that 10% tariff regime. So this vertical spike on the right hand of the chart that you see, it really shows how unprecedented this revenue surge is. Typically, you see some revenue surge in April from income taxes, but you obviously haven't seen something like this occur in a very long time. If the August 1st tariff rate jumps from 10% to 15%, and all these country surcharges kick in on August 1st, analysts project that Treasury revenues could approach $600 billion a year. So to put that into perspective, the federal government collects about $500 billion in corporate income taxes over the past 12 months. So tariffs at a potential $600 billion run rate, it could eclipse and surpass the entire corporate tax revenue that the Treasury takes in. It's pretty staggering. So obviously it bolsters the headline Treasury tax revenue number. It eases some of the federal government's deficit math with the BBB bill that was passed. But tariffs are still a tax. And so the question ultimately is around who pays for it? Importers, US firms, US consumers, and we'll, have to kind of see in terms of how much that revenue source potentially erodes profit margins or consumer purchasing power. We'll get clearer evidence of that as more data comes in, but so far it appears that the consumer really appears to be bending. The labor market has slowed down a little bit, but we're not seeing signs of breaking. And so with that revenue backdrop in mind, I'll turn it over to George Newman, who will walk us through what we're seeing happening in company earnings.
Thanks, Weston. Yeah, I figured it's probably good to shift back to the US and spend a minute talking about S&P profit margins. You've heard us say time and time again that changes in profits drive changes in markets. So we think this is always a good place to focus a little bit of your attention. So where we stand now, we just started the second quarter earnings season. We're still a little early. The bulk of the companies will report over the next week and a half to 2 weeks. If you look at earnings expectations for the whole of 2025, though, which is what this chart is showing, the consensus as of right now is that it's going to be a good year for earnings growth. If you look at the table in the top left-hand part of the screen where you see it in orange, the total EPS, you see that analysts right now have 2025 earnings growing at 8.7% over 2024, which compares to about 7.3% for the 25 years prior, since 2000. So we're running a little bit above average there. Looking forward, on the far right side of the chart at the bottom, the two dark green lines, you see what analysts have priced in for 2026 and 2027. They show growth set to accelerate from here to 14% next year and 12% next year. Of course, these are just expectations. They're not actual figures, but as of today, the market's pricing in very strong growth for the next few years. Looking a little deeper at the earnings themselves and what makes up that combined earnings figure for the S&P, one of the main dynamics we've seen over the last 2 years, really 2023 and 2024, was how the Magnificent Seven companies, the large cap tech companies, outperformed the rest of the market by such a big margin. And I think what this slide really shows is that that was for good reason. If you look at the green bars in the middle for 2023 and 24, you see that those Magnificent Seven companies grew earnings by 30 and 40% versus -4 and +4% for the rest of the market. So looking forward, it looks like the disparity between the two groups is set to close somewhat, not completely, but you see the Magnificent Seven companies normalizing back toward a more normal figure of 16%. And equally importantly, you see the blue bar, which is the rest of the S&P 500, set to grow earnings at 7%, which if you'll remember from the slide before, that's right in line with a long-term earnings growth expectation. Overall, this is a really healthy development for the market as a whole, and you have more companies participating in earnings growth and a market that's less focused and less dependent on the earnings reports of a few mega cap companies. And if you remember Ashi's slide where he was showing the sector performance year to date, I think this is one of the good reasons that we've had pretty broad sector performance. It hasn't just been technology and communications. It's really been, I think, 9 or 10 of the 11 sectors had positive returns for the year, and this is one of the reasons why. On the theme of Magnificent Seven earnings, we wanted to spend a minute on AI specifically, as this has been one of the major driving forces of the Magnificent Seven earnings growth over the last few years, and really one of the main drivers of growth in the whole US economy over that same time. This chart shows CapEx, capital spending projects from Google, Amazon, Meta, and Microsoft. Just 4 companies projected to account for $278 billion this year and over $300 billion in the next 2 years. This CapEx, as you probably guessed, is largely spent building out AI data center capacity. You can think NVIDIA has been one of the main winners of this trend, as they've been one of the biggest receiver of this CapEx spending. But it's not just NVIDIA, it's the other chip companies, it's power and cooling companies and data center REITs, that this money finds its way throughout the whole real economy. The blue line on the chart shows the percentage of operating cash flow that these four companies are spending on capital spending. That number should come in around 50% for this year, which is the highest in history for these four companies. So these are important numbers to watch, because on the one hand, you have a new risk that comes up where these companies have never invested this much money in capital projects before. And so you have the risk that, technological development could render some of that spending, useless or less valuable than it was at the time they spent it. But on the other hand, AI, as we've come to know, is clearly a revolutionary technology that's changing the way we work and how we operate our lives every day. So they have good reason to be making these investments right now. On the usage side for AI, I found this chart pretty interesting. It shows a survey of firms from September 2023, which is the lighter blue, June 25, which is the dark blue, and then the next 6 months, or 6 months from June 25, which is the shaded bar at the right. Overall, the main takeaway is 9% of the respondents indicated they're currently using AI in their business. I think more importantly than that, you have every industry surveyed. If you look at the shaded bars, every industry had more businesses planning to use AI in the near term, in the next 6 months. I think there's two main takeaways from charts like this. I know we've kind of shown similar ideas of AI implementation in the workforce over the last few quarters. First of all, I think it shows that we're still in the early innings of AI adoption. You can say what you want about the spending projects that the big Mag 7 companies are undertaking, but I think it's hard to argue that we're not early in the adoption of people actually putting the tools to work in the workplace. And second of all, as AI applications and use cases become better, this is where the benefits of the technology start to become shared throughout the market and the broader economy as a whole, as opposed to just a handful of tech companies that have really taken all of the benefit for themselves so far. And so I think that's where a lot of the market excitement comes from. I think it's well warranted, because it's a new tech that's quickly changing the way we work and live our lives. And so there's good reason to expect businesses to benefit from it.
All right, so in a nutshell, we are witnessing resilient employment trends. And thus far, the tariff impact has been less than feared. And we have solid underpinnings in terms of revenue and earnings trends that solidifies and, again, underpins the stock market advance. So last, there'll be more to come, that's certain, on trade policy. So I want to thank my colleagues for their comments today. And so now let's turn to some questions and comments. And the first question's about, should we make a guess in terms of the direction of interest rates? And so if we'll see whose crystal ball is the clearest among us. And I think if you think about that, you should probably have a view on the front end of the curve and then the longer maturities as well. Who'd like to take that? We're going to have our CIO take that.
Thank you, George. I think short end, there's been a lot of talk of rates coming down. We have expectations of that. If they do, they would be modest. I would say long end stays flat to up, given the amount of fiscal fear that is out there. And so we're going to need to pay up for people to hold those longer term bonds.
Yeah. So thank you, Ashi. Another question is on commodities, and will the uptrend continue? And indeed, there are, if you look at the commodities, they have been rallying, but it's a mixed bag, right? Because you look at corn prices and they're less than $4 a bushel, and thus farmers can't get their input costs redeemed via selling right now. So you see energy prices as well that they've waned, and just take one look at the gas pump for that. So it is a mixed bag. Anybody have additional commentary on that? All right, well then, if not, let's just move on in private credit. So what's Venturi's view on the private credit markets? And of course, if you follow the financial press, you know that earlier this week, Jamie Dimon was quoted, it was taken out of context in what I've seen, but he was quoted as saying that we're peak private credit, which it's always interesting is like, what does that exactly mean? And again, it's a business that JP Morgan, where he's been long tenure and successful CEO, it's been a business that for the most part they haven't been a part of. So he might he might be regretting some of the decisions there. My humble impression is the remarks are such that the spreads on private credit have come in, meaning relative to treasuries or relative to investment grade corporates, and that they're priced not for perfection, but they're priced cheaper than they have been in the past. So anyone else want to take a stab at that?
Yeah, I mean, I'll just add to that. We haven't really seen a pickup in any worrying stats in private credit. Default rates are very low. Delinquencies on private credit loans remain very low. You know, when you think about private credit, the growth of it is really because of the inability of banks to lend in that market as a result, largely from regulation that went into effect. You know, regulation after the financial crisis is really when banks had to kind of pull back on their syndicated loan originations, and it became more and more difficult to issue credit to middle market companies in the banking sector. And so private credit arose from that, and it's continued to take market share. A lot of borrowers say it's so much easier. It's easier to go through the underwriting process. It doesn't rely upon broad syndication. And you know, from our perspective, we continue to like private credit. We think that, you know, if you have the right amount of it in a portfolio, it can make a lot of sense. It tends to be a little bit less correlated. You know, a lot of the loans are senior secured, which isn't the case in bank loans oftentimes. It's got a floating rate interest rate on it, which, you know, reduces the duration impact of owning fixed rate bonds. And when you go and look at historic credit cycles, when there was a pickup in defaults in the high yield market, private credit, yeah, it had a pickup in default rate slightly, but not nearly as much as the public bond market. And so we think that there's still a lot of reasons to own it. I think you got to be careful in terms of and be selective of what you own and your concentrations, and do it in a diversified way, which we do. But our view on private credit hasn't materially changed.
Weston, thank you for that. Again, we have top managers, and we stay on top of them and the trends, and we don't hesitate to make a decision to change if it's necessary. We have in the past. So with that said, no more questions or comments. So this brings us to a close on today's webinar. We appreciate your time today, your inputs, and most importantly, your continued trust in Venturi. Please let us know if we can follow up directly or via your advisor. Good day.